Okay.
Right. So let's start. So I've as you may notice, I'm in this twice. So I've got my laptop here, so I'll try and do both. But yeah, good. Thanks for everyone for coming. Pricing's a massive topic that no one talks about, and it was amazing to see a lot of interest in it. So in terms of I'll do a bit of intro. We'll talk about kind of why pricing is important and some sort of signs around whether your pricing is right or wrong. We'll talk about a lot of the behavior around pricing. It is often driven by the sort of caveman in us rather than necessarily the Excel sheet. So we'll talk about some sort of psychology behind it. We'll talk about some practicalities of testing and how to kind of run a testing program and some pros and cons of different things, and also give you some ideas to copy, areas that you should be looking at, and then we'll do a bit of a Q&A at the end. So bit of intro for those who don't know me. I've worked in sort of growing companies of various descriptions for 17 years. My sort of early career was around advising companies on pricing. So I worked with a lot of pharmaceutical companies. I worked with a lot of consumer goods companies, and then probably, I mean, I've lost count a long time ago, but about 200 or so startups, and particularly around that kind of commercial piece. I'm a lecturer at London Business School, and I was a mentor there as well, so I have a lot of like early access to these startups. Quick intro on Growth and Company. For those who don't know, we sort of do three things. We advise companies on growth, so work with their boards and their investors on growth. We then hire the right people if that's what they need. Good old LBS salons there, love it. And then we also run a community, and we do events like this to kind of help people's learning and development. And we work with a bunch of like big companies and small companies. And that's the end of my pitch. There's also quite a lot of stuff that's useful in terms of, like, we've got a lot of stuff that we've done on webinars that we've put on our YouTube channel. And also I post some random shit on LinkedIn, so feel free to get stuck in. Right, let's get into the meat. So why pricing? Why are we talking about it? So pricing is the biggest single lever of growth. It is the thing that makes the biggest difference, regardless of what your business is, in terms of changing your trajectory of growth. It is big and complex and scary, but it is the single thing you should be thinking about almost always. The vast majority of companies ignore it. They kind of guess at a price, they follow competition, and the result is that a lot of them are suboptimal. We'll talk about what suboptimal means. Pricing is incredibly quick to implement. It is often a line of code or a change to a pitch, and it can be done extremely quickly, and it drives all of the metrics that are underlying to the health of the business. So your CAC, your LTV, your underlying growth, and it can also make a massive difference to your cash flow if you're kind of bringing payment earlier in the cycle. That makes sense? It's going to be really boring me talking, so feel free to interrupt me and ask me stuff. So pricing is more than price. You think about, well, actually it is the price, but it is different components around that. So it is, how much you charge, it is who is the customer, it is, what are the customers getting, what are they getting for the price that you give them, and how are you explaining or justifying your price. So it combines your product strategy, your sales strategy, or go-to-market strategy, your marketing piece, as well as the absolute price of what you charge. And your price is probably wrong in most cases. So a few sort of warning signs to look out for. One is that you've never looked at it before. You've just guessed. You've looked at a competitor, you just copied them, felt right. It's probably wrong. It's not a topic at the kind of SLT. You're not taking it seriously at the right level. That's a bit of a concern, because you should be talking about it on a regular basis. You are pricing based on cost plus methods. So you're saying, we buy this for X, so we need to add 20%, and we're doing it. Almost always the wrong approach, because it's not how the way the consumers look at things. If you're never getting pushback from consumers on pricing, that's also a concern too. Like, you should be getting a bit of friction. Like, you shouldn't necessarily be the cheapest in town. You should be getting some pushback, and that's okay. And the opposite of that is you're getting too much pushback. So a balance of that. If you have a single price point, it's very, very, very rarely the right thing to do. So you want to be charging different prices to different consumers with different use cases, which we'll talk about in detail. But if you have a single one-size-fits-all subscription or price, it probably doesn't fit everyone. So that's a little warning sign. And generally, if you're selling on the price rather than the benefits, it's not a great place to be unless you have a massive price advantage over everyone else. So that make sense? Maybe some worrying truths of things that I think, ah, shit, I can see a few things that we've done on that. But yeah. So let's talk about the kind of behavior of pricing. So pricing is a lot more kind of caveman than Excel sheet or CFO. And consumers are a lot more irrational than they would like to think. And this goes for B2B as well as B2C. So I did a lot of work with, you know, big healthcare organizations that are buying hundreds of millions of pounds worth of drugs. They still make really silly, irrational decisions, even when it's massive, complex deals. So a lot of it is driven by how our kind of brain works, our psychology, and it's often quite irrational. So two good books on the subject, Thinking Fast and Slow, which you probably have seen. It's about kind of two sides to your brain. One is sort of quick reactionary and one is kind of considered. In the world of pricing, if you make people consider it for a long time, it's probably going to harm your conversion. You want kind of intuitive heuristic. And then predictable irrationality is, it's got a lot of interesting anecdotes in there of situations where consumers have done things which are irrational and don't make sense, but they do make sense when you think about how the brain operates. You know, so for example, there's a big thing in the US around, you know, how much people save for retirement based on how many choices they get. And if you give people more choices, they just don't save anything for retirement. So it has a, you know, hundreds of billions of dollars worth of impact on the US just because you've given people 12 funds to invest in rather than 2 or 3. It is completely irrational. Consumers are, you know, destroying their future retirement because they're just overwhelmed by choice. So these two books are really good things to look at. So I'm going to go through a sort of few, like, kind of way that they're sort of, it's not quite deep psychology, but sort of how the brain operates and how people are kind of thinking when they come into situations where they're making a choice, and price is ultimately a choice decision. So humans work in basically heuristics. So heuristics are kind of rules of thumb or kind of easy ways of viewing the world that simplify the way we look at things. And where pricing follows heuristics, it works quite nicely. Where you have a pricing strategy which goes against heuristics, it creates a lot of friction in people's brains. So you have a, I can't remember talking about system 1 and system 2, and I can't remember which way is which, but it creates a lot of friction in your brain because you're like, hang on a sec, that doesn't make sense. So the nice ones that we use in pricing are, you know, if you buy more or you commit longer, you expect to save money. Like, it's kind of common sense. If it is better quality, you expect it to be higher price. So in situations where you struggle to understand the quality of a product, it can make a massive difference. So, you know, do you want to be seen by a doctor who's £500 an hour or one who's £100 an hour? I'll probably have the expensive one, thank you very much, because I can't really judge quality. But if they're like expensive, they must be good. You know, reassuringly expensive is actually a really common thing. So, you know, to Nick's point, you know, lowering your price may worsen your conversion in some situations. It is not necessarily the way you might think it would be. If things are bespoke or they're faster, they're better, they've got more features, you expect to pay more. And if consumers are expecting to pay more, but you don't charge them more, they, you know, they can question the value of things, but also you're kind of leaving money on the table because they were willing to pay more for a feature. Does that make sense? The second thing is, loads of thumbs up, I love it, is inflection points. So consumers don't make decisions on pricing around individual price points. They make decisions around certain prices where their decision changes. Let me give you a little example. So if you're in London and someone offers you a latte for £1, you get to kind of question whether it's a good coffee at that point. It's like, hang on a sec, not, is this really a good quality product? I don't know. This seems a bit low. And if it sort of costs like £2, £3, you think, well, this kind of makes sense. This is good value. But your decision to buy a coffee doesn't change within that range, right? Once you go kind of over £1, you're not going to suddenly your decision is not going to change. So in pricing, you don't want to be at the bottom. You don't want to be at the bottom of a new range. You want to be at the top of the next range. That makes sense. So you don't want to charge £1 and a penny for your coffee. You want to charge £2.99 in this case, because your decision is not going to change massively in that period, but the price point has gone up a lot. So where the price point starts to go up, it starts to become a little bit more of a considered purchase, and a little bit more of like, okay, £4, £5, kind of normal, a little bit expensive. Do I want it? But again, in this case, if you're a coffee shop, you want to be £4.99, not £3 and a penny, because your consumers consider you in that category, and that's the category you want to be in. And then once it gets expensive, you've made that decision. So we'll talk about this in a bit more detail. There's a methodology for this that we'll talk about, and we'll go into kind of nuts and bolts. But it's an important point to think about, is that what are the points where people make decisions differently, and it partly depends on what their benchmark is. So they can have like rules of thumb, but in situations where you're selling a product which they haven't bought before and they're not really sure what the price should be, you can also help them to anchor it at the right level. So people do things like, price per day for insurance, or, your life insurance only costs you less than a coffee a day. And you think, well, a coffee a day is quite cheap, therefore this is cheap, rather than saying it's £500 a year or whatever the numbers are. So helping people benchmark can be quite useful, because it can really drive their decision making. So for an example, the benchmark can be different to what you think, right? So an expensive Deliveroo is a cheaper version than a restaurant meal, even though it might be an expensive delivery. So it may not necessarily be the same category. They might just say, look, when it gets beyond a certain point, I have to think about it. And it's not necessarily a category that's driven that. Does that make sense? Make sense, guys? Few nods, cool. So thinking about bundling. So let's say you've got 3 bottles of wine. They are literally the same bottle of wine. It is the same brand, the same size, exactly the same. And they are quite radically different prices for different consumers. And why is that? It is because they are part of a bundle. So if you go to a supermarket, you're buying a bottle of wine, but you sort of get a discount for pre-planning. You've bought it in advance, you stick it in the fridge, you get a bit of a discount for being organized. You go to the local corner shop, you haven't been planned, you want a bottle of wine, you're paying a bit of a last minute fee because you hadn't really thought about it. And if you go to a restaurant, you're buying the ambience, you're buying the service, you're buying someone to pour it for you, wash up the glasses. So we as consumers are quite used to this, right? We do this all the time. Like, we know that wine in restaurants is really expensive. We know it's the same stuff you can buy in the corner shop. We know the corner shop wine is more expensive than Tesco. Because all of it is a bit of a kind of bundle. So every single product that you sell is a bundle of stuff in it, regardless of what you think it might be. So you are paying for things, and consumers are it's very difficult to be like, imagine you go to a coffee shop and your coffee is like £2, but then you pay like a kind of seatage charge. Consumers just don't really understand it. So everything is a bundle, but splitting the components of the bundle can be quite difficult for consumers to think about. That makes sense? And Nick had a comment about bundling of wine. Paired menus. So regardless of whether this is B2B, whether this is anything, if you're buying a warship and you get it delivered next week rather than getting it delivered a month later or a year later, it's a different product. Even though the product that you look at is the same product, it is fundamentally different. And whether this is B2B or B2C, your, I don't know, fancy CRM system that you can install today is different from your fancy CRM system that you would install in a month's time. If I pay now or I pay in advance, it is fundamentally a different product. And that's what you can play with. And in terms of like consumer psychology, consumers are walking into kind of pricing decisions or choice decisions with a sense of value. And this is particularly true where they haven't bought things before and they're not really sure what the price should be. Like consumers want to get good value. They want to feel like they're doing a good job, whether they're doing it for their own wallet or for their company's wallet. And there's a lot of things that happen to kind of help people reassure them. So a discount is not necessarily the right thing for all situations, but it does help you anchor the price by saying it was more expensive, it's now cheaper, versus its previous price, it must be a good price, and it helps you kind of reassure you. Benchmarking is super useful, so it can be benchmarking around competitor products or other situations of saying it would normally cost you this, or the competitor costs this. That kind of helps to reassure you. It helps to kind of help answer that question of value. And social proof does a little bit of that as well. So 100 of these have been bought last week. We sell to all these different customers. There's a lot of things that do that. And the companies that test this an awful lot are particularly travel websites and Amazon, basically. So thousands, hundreds of thousands of A/B tests to really do this stuff. And a lot of it is deeply ingrained in that consumer behavior. So it's useful when you're thinking about pricing. This is what your consumer is going to be thinking about. Is this a good price? And how do you help reassure them that it's a good price? How do you kind of build a bit of confidence that they're making the right decision? And there's a lot of ways to do that. Does that make sense? Racing through. So let's talk about how to test pricing. So pricing is a scary thing. It is maths. It is human behavior. It is also quite a lot of like practical implementation in terms of the company and your margins and how you're going to sell things. So it is not an easy process to do, and we'll talk a little bit about that. So this is how kind of most prices are set. Arguably even simpler than this. You sort of look at your competition, you say, I think we're similar to this, therefore we should be roughly this price. And you might talk to some customers about their willingness to pay, and that's kind of what you're going to do. And so you're going to, basically it's sort of a rough guess, and that's what's happening. And that's how probably 99% of prices in the world are set, if not arguably more. And there's a lot of problems with this. So from the competitor side, you're assuming a bit of an information bias here, or there can be an information bias. So you're assuming that customers have done their research and they know the prices of the competitors. And that's often not true. Like they're not necessarily looking at every single competitor. They don't have an Excel spreadsheet. Even in quite big, expensive B2B situations, you'd be surprised. And customers also don't necessarily view pricing in the same way that you do. So if you think about when I used to work in pharmaceuticals, and we'd be doing these massive deals with governments, and they'd still be looking at, we'd be trying to charge based on price per month per patient, and they would be looking at it in a price per bottle. And these are smart guys who do this for a day job, and you're like, well, our thing is a month's supply and theirs is 2 weeks, and therefore that's why it costs twice as much. So the viewpoint that you view pricing in is really important. And if you think about things like paint, for example, if you're a paint manufacturer, you're probably looking at the price per tin, whereas if you're painting a room, you're probably looking at the total price to repaint your room, which might include decorators. It might include a bunch of other things. So you're looking at it in a very different frame of reference, and therefore you can overestimate your price sensitivity. And then on the consumer side, this is probably the biggest mistake that people make, is that regardless of what your price was, the people who paid that price thought it was a reasonable price. So if you go and ask customers about your pricing research, well, no shit, they think it's a decent price, because all of the ones who thought it was too expensive never bought in the first place. So it's a massive thing. In my old company, we were massively too expensive, and well, we got a lot of customers. I was like, yeah, but we could have got a lot more when we reduced pricing. So it is the biggest mistake that people make, and you just got to be conscious that when you talk to customers, there is some use in it. I wouldn't say don't do it, but they're not really the audience you're going after. You're going after a different audience, and therefore you want to be talking to nearly customers, which we'll talk about in a second. That makes sense? Yeah, some takes. So we'll talk about a sort of different way of doing things, a little bit more complex, but we're kind of going on a bit of a journey. So by a journey, I mean there isn't a single thing that you can do that will tell you the answer. You are gaining information, you are learning things, and you are narrowing it down rather than asking a key customer this magic question and that's the answer, because it is complex. So you're first of all starting off with customer insight. So understanding who your customer audiences are, how do they make decisions, what is your competitor set, and what do customers value. So for a paint company, your competitor set could actually be a sofa company, because you could be like, well, I'm either going to buy a new sofa or I'm going to renovate my bedroom. Right? So it may not necessarily be other paint companies in that thing. We'll then look at price sensitivity, so looking at the inflection points that we talked about before and looking at how consumers change their behavior. We'll then look at validating scenarios, which is basically having some hypotheses around different price points and then going to test them and validating through. And then we'll also talk about rolling them out. So how do you roll them out without pissing people off, basically? What are the ways of doing that? Understanding the risks of doing it. I think a lot of companies are fully aware they should be testing pricing, but they're scared of getting it wrong and having backlash with it. And there are definitely ways to understand how big that backlash is and ways to mitigate it, which we'll talk about. That make sense? Cool. Has anyone read the mum test? Let's start with that. Yeah, I knew Nick had a few yeses. So quite frankly, you don't need to read the whole book because it's a very simple proposition. You can probably just read the first chapter. But basically, the mum test is a way of interviewing people without biasing them. And the idea is that when you talk to your mum, they love whatever you do, and therefore they're going to be super positive. So to summarize it in a sort of sentence, instead of asking people their opinion, you ask them about kind of tangible things that they've done. So if you say to people, do you go to the gym? They'll probably say yes. If you say to them, when was the last time you went to the gym? Oh, 3 weeks ago. Well, you probably don't go to the gym then, do you? So you get a very different answer. So you're not saying, our product is amazing. Do you think it's amazing? Yes. You're asking them about, how did they make decisions? How did they do things? What were they thinking about? Rather than trying to kind of test them on a single thing. So customer insight is critically important. I would, as I talked about mentioned before, your nearly customers is what you really want to grab. So the people that you've already sold to before were happy with whatever you told them, whatever the price point was. What you're really looking for is the customers who were, nearly about to buy it. So they attended a sales meeting and didn't buy, or they've looked at the website with their credit card in hand and something happened. Those are the customers you really want, because they are the ones that you're wanting. If you want to grow a business, you have to attract new customers. You have to attract people who are close to buying rather than just random people on the street. So as you do pricing research, you've just got to be very conscious of, am I targeting the right audience? Because they can be quite biased. really focus on one-to-one interviews. They're by far the most useful thing. I think there's a lot of people are concerned that it's a waste of time, but the real richness of the one-to-one interviews is so important. So understanding, how they made decisions, their kind of emotions behind it, rather than just a survey. So surveys are very biased. You're putting your own biases on it, and you're missing some of that richness. If you go back to the paint example, if you're a paint company and doing a survey, you can ask about paint brands, whereas actually the alternative could be, well, do I go on holiday or do I renovate my room? Like, that's probably the decision that people are making, rather than do I use Dulux or something else. You can also look at sentiment analysis, quite useful. So reviews, some quite nice tools recently that you can scrape Reddit for, and you can look at kind of how people are thinking about a certain category. You can also look at complaints. So during this process, you're looking at, how does their product or service fit into the real world? How are they going to use it? Who makes the decisions? How do they make decisions on buying it? So, who decides to buy it? What are the alternatives? What features are they looking at? And often this is emotional things rather than practical things. So they might give you a practical reason, but often it's emotional. So, I'm using this new AI tool because I want to look good in front of the VP of sales, rather than necessarily it's because it has some feature that I desperately need, right? There's a lot of things that are different to what you might think, and therefore going with an open view is thinking about it. And then thinking about kind of pricing and how they view pricing. Do they view it on a per user, per month, per milliliter, whatever it is, because you've got to make sure you're talking the same currency. Make sense? Cool. So now we'll talk about a Van Westendorp. Has anyone heard of a Van Westendorp? It's a raised hand, a couple of raised hands. I'll assume that most are on the no category. So Van Westendorp is a way of understanding inflection points. So we talked about that previously, that you don't necessarily change your opinion on a coffee, whether it's £2 or £2.20 or £2.30, but there are certain points where you think, hang on a sec, this is expensive. And that's what you're looking for in a Van Westendorp. So to keep it simple, you basically ask people 3 different questions. So you say, at what price point is it good value? At what price point is it expensive, but you would buy it? And at what price point it is too expensive that you wouldn't buy it? You can sometimes ask, at what price point is it too cheap, that I question its value, but can be a little bit misleading because it depends what it is. And basically you plot the numbers, you put them in order and you plot them based on percentages. So if you look on the chart, at a certain point, at £10 on the green line, so whatever it is, 20% of people think it's too expensive at £10 and 80% don't think it's too expensive. So what you're looking for is points where behavior changes quite significantly. So a point where they're like, hang on a sec, this is no longer cheap, I really have to think about whether I want this, or this is ridiculous, I'm not going to buy at this point. And understanding those price points. And your consumers will have quite different views depending on their ability to pay, their use cases, lots of different things. But you're looking for that sort of grouping. Does that make sense?
Sorry, quick question.
Yeah,
and I can see Nick's raised his hand as well. So is the question, what is the maximum price point at which it would be still good value, that it would still be a bit expensive, but doable and so on? So given that good value could spread over a range, you're trying to put some point on it. So is the point the max?
Yes, exactly. You're trying to get the max. It's worth thinking through the language of those questions quite carefully. There's quite a few good resources around, so you can sort of get the wording right. But you're looking at, basically you're asking consumers at what point they would change their decision. So the maximum is quite obvious. So what point it would be too expensive, you just wouldn't pay for it. But yeah, you're framing it in that way for the at what point does it become expensive that you would buy it, but it would require more thinking through. I mean, that's not a great phrasing, but like that's basically what you're asking. Nick?
This may be a stupid question, but I wondered, presumably with a sample size of 200, this would be via survey rather than kind of accumulated interviews over time. And secondly, how would you kind of tee up the survey in terms of ensuring someone understands your value proposition, but not biasing the survey?
Yes, very good question. So bigger sample size, the better. But the methodology still works, even if you were to do a handful. So if you're on a sort of weird B2B situation, it's still useful to understand that. Obviously, it's not going to draw a pretty graph, but useful to understand at what point. So it's useful to understand, even if it's not statistically significant, it's still like, okay, at this price point, these guys are like really considering it. And they'll often have like rules of thumb that will guide that as well, to be like, beyond £1,000 a month just feels like a lot. So then I would really consider it. So it can be useful. In terms of, it's a difficult line to get right, because if you kind of indoctrinate people too much, then you sort of violate the principles of the mum test. So there are ways you can do it online where you kind of show your product with the branding that it looks like. There's some like user testing sites that can do that, and you can get the right traffic in terms of people filling it in who are roughly the right demographics in the right country, and you can give them a little bit of the look and feel of the brand. You also want to think of like, what is the case that they're going to see it? So if it's B2B, they're going to have time to think about it and discuss it. If you're basically running meta ads, they're going to make a decision really quickly. So you want to kind of replicate your pricing decisions in the reality of what's going to happen. Is they're going to be on mobile, they're going to click on it, they're going to make a quick gut decision of whether this feels right. So you want to try and get your testing to be as close as reality as possible. But if you said, like, spend 5 minutes looking at heights and saying how wonderful it is, now let's talk about pricing, they're going to be massively more positive than the reality when you're, click on the ad, I like it, too expensive, la. So you want to try and replicate that situation as close as possible. And it's not easy to do that, but just be conscious of the bias that you have when you're doing the sampling methods. And again, it goes back to, there isn't a single silver bullet of research. You just have to think about, the Van Westendorp is useful, but did I bias the people by telling them too much information, and maybe they're a little bit optimistic, or maybe I got the wrong demographic and maybe they're not right. So you just got to think about that way. I think there was another question. Mel, did you have a question there?
Yeah, thanks. This is very interesting. I've actually mostly done conjoint, predominantly to understand the brand effect. Because in so many times with the products where, the brand perception skews what people think is a good value. I mean, iPhone is a classic example where it's really gone. At Nokia, I remember buying Nokia phones for much cheaper, and now you're looking to spend anywhere between 15 to 700 pounds for an iPhone. So my question is, I've not done the method that you're saying when Westendorp, but it's like, how do you take brand into effect, and especially when pricing category defining products? In my case, I worked on Moonpig, AirUp, products where completely there's no categories, and where there is no concept also. Categories, you use, for example, you use paint, Farrow and Ball, which again requires 2 coats of paint, and the people who's painting are also expensive than Dulux, for example. So how do you take those brand aspects or premium positioning into consideration with this methodology?
Very good question. And the answer is that all of the methodologies have problems with them. So you have to look at them in the round. You're doing this to kind of narrow it down rather than to give you the price. So you're doing this as part of your, we'll go on to the next bit of like unlocking where do you look at and where do you test. I think where you can run the Van Westendorp, I actually tried to trademark it myself and realized I couldn't trademark it. But basically, you're running product testing with a view of the product itself, because you get a bit of the brand element as well. So if you show a sort of, I don't know, a bottle of wine with a generic label versus a bottle of wine with a nice label, you're going to get a very different view because you're talking about things in an abstract. So just being conscious of the bias of it, where you can use kind of user testing and these sorts of things, where you can show like, do you pick A or B, or you show the product, and try and show it in the way, as I mentioned before, of like, if they're going to come through Facebook ads, don't show them the product for more than a couple of seconds, because it's just going to be not representative.
Okay. Thanks.
Ashim?
Thanks, Joseph. I am sorry if this was already addressed, but since we are speaking to Van Westendorp, I had a couple of quick questions that are posted on the chat as well. So in the range of price of marginal cheapness and marginal expensiveness, should we always play in that range? If yes, then the two questions are, how frequently do we evaluate that range? And let's say our list price is in that range. If we are offering discounts and promos, should we still stick to that range after coming up with those discounts, or can we touch on the price of marginal cheapness or go beyond that as well?
So we'll talk about, there's not necessarily a definitive point in this chart that says this is where we need to be, and we'll kind of talk about that second. It starts to get very complex, but where you have a situation where you have a list price versus a net price or a discounted price, you can play with price to do different levers for you. So having a sort of theoretical price that no one actually pays is quite useful, which goes slightly against this. So having, I don't know, £100 list price and a £50 net price is quite useful, but the testing can be difficult as well, because if you're going to a website and it says, £100 scrubbed out and £50 is there, that's different from just showing £50, and you'll get a different sensitivity to that. So these things have to be kind of taken in with a bit of a pinch of salt and a bit of a kind of holistic view, because they have limitations. But where you have a list price, there can be an argument of basically it's going to push it higher, but it's not the same as pushing your overall price different, if that makes sense. So £100 discounted to £50 is not the same as £50. So as long as you're kind of conscious that those two are not the same, and if they agree on £50, they haven't necessarily agreed on that. I think there's a question in the chat. Let me just have a look. Would you run it on existing competitors? I mean, I definitely run it on as many people as you can. I would split the audience, because you will see a very different price sensitivity, because existing customers have already used the product, so they've already seen value in it. Whereas customers are coming in, are believing the proposition, but they haven't seen the proposition. So just being conscious of that bias, but it is useful. You might get some more sensitivity from it. Caroline?
Yeah, I was wondering how you kind of align that with a subscription product where you would have your standard price that you want them to be willing to pay, but you also are likely to be bringing them in on a discount. So like, how do you align the two and test the two? And particularly in terms of like, if you're testing discounts, to understand how you're going to get the customers who are actually willing to pay the main price once they come off whatever the discount is.
Again, not easy, not a definitive answer, but probably a good segue to the next bit when we talk about them. So once you've got, basically, you off the back of that, you're going to get some ranges and some price points, right? So as we talked about, you want to be towards the bottom of these ranges, at the top of the range rather than the bottom. So you might say, well, we can be 19, pounds, low margin, and that's going to require quite a lot of volume to get us to attractive business. Or the top end, you could say, you know, we're going to be competing in a bigger league, therefore do we have the right features? So it is not necessarily a mathematical question, it's also a bit of a kind of business common sense. Like, if we need certain features at this level, do we have the brand, do we have the product to do it? And do we really think we're going to capture this entire market at this level? So at this point, you're probably going to get rid of some of them. You might say the bottom's just too cheap, we're never going to make it. And then you're kind of bringing these price points with you. And to your point, Caroline, these price points can be, you know, 1 month free and then £50 could be one price point, or it could be 2 months free and then £50. Like, that could be a separate price point to test forward. It doesn't necessarily have to be a single price point. It can be a sort of price proposition, which you're moving forwards. You then can do something called a Gavel Granger. It's kind of a fancy way of just saying testing it. But basically, the sort of principle of this is that you've talked to a bunch of customers at the beginning, you've got a sense of where the price point is, and then you're basically going to play it back to those customers and see what they would do. So you say, okay, you've got a 1 month free trial, and then it's £50 a month. Are you going to buy, yes or no? And what you're trying to get is a rough sense of the conversion or the uptake. It's not going to be exactly the same as an A/B test, but it does give you a rough sense of that. We'll talk about A/B testing next, but you basically want to play what you think is right back to the consumers and see what they would do. And so previously we've asked them about the price point. At this point, we're now telling them the price is this. What are you going to do? And you want to funnel them into a yes or no. You don't want to funnel them into a maybe, because they'll always say maybe. So would you buy it, yes or no? And that will give you a sense of, you know, a sort of validation of some of the stuff that you've learned in the Run Western.
Sorry, Joseph.
Yep.
That's in hypothetical products. In other words, you're saying, if we were to do this, rather than actually launching and testing different prices, A, B, C, D style. So it's still a hypothetical thing.
Yes. We'll talk about this slide actually, but like price testing in the real life, you know, you've got to be public with it. It's risky. There's a lot of things that could go wrong with it. So you want to do as much as you can in a sort of theoretical safe space, and then you go into the reality of how it works. So, you know, these things have limitations, but they kind of help to de-risk it a little bit before you go public with your, you know, your kind of massive thing. So if you're Netflix, it's newsworthy when Netflix changes its price. You want to do as much testing as you can behind the scenes to make sure that's right, and then you go public with your price testing. So as much as you can. Neil.
Just a quick one, Joseph. When you say you play this back to them, I'm presuming you do this with a brand new sample size of customers, not the ones you actually talk to in the Van Westendorp method.
Ideally, yes, but it may not be the reality of what you have. You might have to work with the sample size you have.
Okay, cool.
And you can also do this qualitatively. So if you've got a niche B2B business, you still want to go back to them and say, this is what you told me, I've got some ideas, what do you think about these ones? It's still useful. Even if you just do a quick chat with 5 people, you'll still get a rough sense of it as well. And then in terms of real customer testing, so, you know, basically you can A/B test it. To start with the bottom one, you can A/B test or B2B. If you're doing sales pitches, you just divide them up. Don't divide them up by salesperson, because then you're testing the ability of the salesperson. But you can A/B test in B2B. You know, have the phone number of the client and just change, you know, odd ones get this and even ones get that. Works very well. But in terms of B2C, you're basically sticking it through an A/B testing tool. And a few considerations here is customers may well see both arms of it. So if you look at it on your work laptop and then you look at it on your phone, you could be in different arms of it. Husband and wife could be in different arms of it. So they may see the other price. Just bear that in mind. It's not always legal. I think there's some questions in the US of whether you're allowed to do this because you're charging different prices for the same consumer. So definitely check that. And just thinking practically about how long you want to run this test. If it is a one-off purchase, you can run the test really quickly. If you're looking at a subscription product, and LTV is the most important thing, you can win in conversion and lose in retention. So you have to run these tests for quite a long time. So all of this is, and this is a robust way of doing it, but it's also quite expensive and quite scary. So you want to do as much as you can before you get to this point. And then thinking about kind of rollout consideration. So first of all is the price visibility. So how, you know, are consumers going to see this? If they are going to see this, then we have to think about it very carefully. If it is a B2B or a sort of customized insurance quote, they're not going to see it, and we can test as much as we want. Are we going to roll this out to new customers, or are we going to keep it to, is this going to be new customers only, or are we going to keep it to old customers? If it's new customers, you can roll it back quite quickly. If you're telling your existing customers, it is a big and scary thing. And obviously, if you don't change the price for existing customers, the whole impact is going to be fairly small. Thinking about your comm strategy, how you're going to message this, how you're going to justify it. Blame inflation, it's a nice one. And also kind of time it with new features as well. So if you're launching a new product, it's a good way of doing it, and you can fiddle with your levels of product. And can you test it in a selective way in real life? Your testing is never going to be exactly the same as real life. So can you test it in a different market or a different audience? That's exactly what Netflix do. Netflix test pricing in like Australia, and then they'll, if they think it's the right thing to do, then they'll launch in the US. A question from Tom. What are the trade-off factors of doing a 1 week price A? I think you mean testing it at one price for 1 week and another price for a second week. You can do it. You obviously got to assume that those 2 weeks are the same and that they're representative. If you've got a consumer price and you're heading towards the end of the month, they can be quite different. It's an okay method. It's got limitations, but everything has limitations. No worries. So a few mistakes to avoid. We sort of touched on a few of these. So the wrong customer viewpoint. So are they viewing things in a different way than you're positioning it? You can overstate price sensitivity by these sorts of things. A little bit to Nick's point, if customers don't really understand the product, then they give you kind of nonsense answers, and it can make a big difference. So if they haven't really understood the value of the proposition, they're not going to answer it. But you also have to be conscious that consumers looking at a website also don't fully understand the proposition. So if you educate them too much, you'll bias it as well. Wrong customer, wrong moment. Painkillers is a really interesting one, because if you talk to people about painkillers when they don't need them, you get a very different view. If you've got a headache and you talk about price sensitivity, you'll just throw money at the problem. And if you try and ask poor people about Ferraris, you'll get a nonsense answer as well. So just being conscious of that. And then I mentioned previously, don't talk to customers about the price point they paid when they already paid it, because they're going to say yes, and you're going to feel really good and warm about yourself, but it's total nonsense. Does that all make sense before we go into a few ideas? Right, so here's some ideas to copy. Adding in a setup fee is really effective. It's quite common in B2B. It's common in gyms, and it really makes a massive difference, because people, you as a business have more costs at the beginning because you're setting things up, and people are quite expecting to do that, right? If you're a digital marketing agency, charging more in the first month as a setup, quite a reasonable thing to do. Not an unreasonable ask at all. It can make, customers often expect it, massively improve your cash flow because you're taking a bunch of cash up front. Customers are committing more, so their LTV is generally higher. And you can also use it as a great incentive to say, look, if we can sign the deal today, then we'll throw in some training that we normally charge $5,000 for. And the reality is no one's ever paid £5 for it. You know, my local gym has a 0 joining fee. Nobody in the history of that gym has ever paid a joining fee. It is complete nonsense, but it's a useful sales technique. For those who are familiar with Clarkson's Farm, they were not allowed to sell t-shirts, so they had to sell Brussels sprouts for 25 quid and you got a free t-shirt, which made me laugh. Particularly for B2B, particularly for marketplaces, you can radically change what people are paying for. Are you paying for usage, or are you paying a subscription? Are you paying for a lead, or are you paying for a sale? It can make an enormous difference. Very complex, you know, quite hard to predict what's going to happen, but it can make a massive difference to disintermediation. It can make a massive difference to LTV, and also lowering your friction to test things. So instead of committing to a monthly subscription, you're charging per usage, can make a huge difference. Bundling and unbundling. EasyJet built their entire business of unbundling. Makes an enormous difference in terms of, you know, reducing your cost to serve, improving your margin for certain audiences because you can charge more. You can also put off customers that you don't want as well. If they have a very complex setup and you know it's going to be a real pain, you can just charge a setup fee, and the ones who pay it, you make some money on. The ones who are put off by it, well, it would have been a pain anyway. So you can do it quite carefully as well. And then bundling, it can improve choice fatigue. So if it's too complex, it can make a massive difference. And you can also push up heavy. And then the other one I had, which has been massively effective, is splitting your product into small, medium, large, or good, better, best. In my old company, we split one of our products into 3, and the revenue went up by 115%, which is absolutely ludicrous because we a little bit careful about what we added to each of the different buckets, improve the product for all of those different audiences. So we had a lower price point, which appealed to people who were, you know, kind of low usage or a bit more price sensitive. The people who were fully in, we gave them an opportunity to pay more money. Massively effective. It only took, I don't know, 2 weeks of customer insight and then a day of dev time, and yeah, 115%. So it can make a massive difference. So particularly SaaS things, fiddling around with what you have in your beginner tier versus your enterprise tier, hugely effective. And it's also a good way of getting pricing over the line without it being too big and scary, because you just sort of nudge the stuff that people bought in the normal tier into the premium tier, or you add a super premium tier, whatever it might be. That makes sense. So I tried to give you some examples that you can basically copy. So a lot of consumer stuff is useful for B2B, and a lot of B2B stuff is useful for consumer. So you know, I'm going to pick on Nick so I can see him, but like having an upfront fee for vitamins and minerals in the post, not unreasonable. They might agree with it, and it's going to make a massive difference to unit economics. So that's the end of the formal stuff. Do you guys have any questions or anything you want to debate?
If we've got a couple of minutes, do you want to give any examples? A business that you run that we're probably all more or less familiar with is Growth & Company. How do you think about the pricing there? So is there any research you've done? Have you thought about inflection points? So if you're comfortable divulging anyway, anything on that side, just giving a tiny bit of a case study.
I mean, some of the irony is I don't necessarily follow all of my own method. But when I started, we basically we do like a diagnostic with the company, and we like help them figure out the right job, and then we do the recruitment. And I charge them an upfront fee, which logically makes perfect sense, but practically is a real pain, because people are like, well, I've written a JD, so now I have to pay a fee to go back and do more work to get to the point where I already am, and they really don't like it. So logically, it's quite common, but it just doesn't work, and it just caused a friction. And actually just rolling it into one, so bundling it was the right thing to do. There's a lot of things that sort of make sense in theory, but are kind of against consumer behavior. So, if I get a candidate a job that's better and better paid, it's not crazy unreasonable for them to pay me money for that. But it's just not the way that the world works and not the way that culture is done. So I would struggle to get it done. So simplicity, like maximizing price versus simplicity of sale, is probably the lesson here. And actually, a simpler model is often better. Armel, I think you were next.
Yeah, have you seen any difference in the price elasticity across countries in Europe? If you've done those, like, is there like a typical? There's more elasticity like in France or in Italy, or the other way around.
So to answer a slightly different question, I'll answer that. So in my old company, we managed to look at conversion rate based on postcode, and I pulled the income per postcode, and it correlated so well that I thought it was fake. So income and conversion generally correlate very well. So, Sweden, Nordics will generally convert a bit better than other places. I think there are some cultural issues as well. I think the Germans are sort of more considered in their purchases, but they generally have higher LTV, so they'll take more time to think about it. But once they're happy, then they'll stay for longer. But willingness to pay and income generally correlate extremely well. Are there questions in the chat?
Just for me, because it's quite a live topic for some of my clients where there's, too many SKUs, and especially with the recent, things like pricing for TikTok Shop, same product, and there are different variations. And, when you're looking at omni-channel model, so like if your product portfolio is same, how do you make sure that, the pricing that you're showing in TikTok Shop versus Amazon versus Shopify versus retail? Because you still need to give people the reason to come to your D2C, and with retail, when you don't control the pricing, you can only recommend it. So sometimes the pricing in retail could be so different than D2C, and your conversion rate drops down. Have you any experience, in terms of how to manage when you're multi-channel, and maybe there's not much product differentiation?
Yes, we experienced that. We had it at Grays a lot of times. I mean, your different channels have different sensitivities because they have different use cases and different kind of buying behavior. So ideally, you would have them as separate. So, if you look at what Coca-Cola do, which is quite interesting, is they will sell an Aldi, but they will sell a slightly different pack. So it's not comparable. They'll sell like a 6-pack rather than an 8-pack, or something that's slightly different. So, the supermarket's quite sensitive about that. They don't want to be seen to be price referenced. So they're quite happy for you to have a slightly different pack. So, if you look in Aldi versus Tesco, they will have slightly different sizes. And that's a way of avoiding it, so they don't get price referenced. So ideally, you price them independently because they're different channels. But the longer answer is sort of thinking about the value proposition of different ones. So you might have, on your own site, you have more flavors or more choice, and on your other ones, you have less. But you're maybe kind of a lower price point, but your sort of premium stuff you keep to yourself.
Sure.
But yeah, it's ideally you price them separately, and if you can do that without annoying too many people, then that's the best thing to do.
And one last process question. I know, sorry, we are already time. Like, how with us, we have so many marketeers in the room. There's all the levers. You have subscription roadmap and acquisition roadmap and retention, CRM. Obviously, pricing is generally untouched, but it's a very, very a powerful roadmap as a lever. In your experience, how you have identified pricing as the lever. How do you operationalize it? So, in your experience, how you have seen best, just like a CRO being a lever, where you have seen the success of operationalizing pricing as a lever?
It's a good question. I mean, first of all, just making it a topic of conversation, understanding that it is important, and that you know, at a high level, it needs to be kind of discussed on a regular basis. Not accepting that it is scary, but you're still going to do it. So a lot of companies sort of say, oh, well, that's a bit scary and it's probably wrong, and then they kind of chicken out. But it's sort of scary, but we're going to keep doing it, and we're going to test in ways that are, you know, minimizing the risk of doing it. So, you know, having grandfather pricing, these sorts of things. But I think just making it a topic of conversation and understanding that, you know, it is the elephant in the room and you are aware of it, and it is a massive thing that you could be doing. Yeah, it's part of your kind of general CRO work as well.
Sure. Cool. Thank you.
There was a question up here which I thought was really interesting. In terms of nearly customers, how do you find nearly customers? And the answer is quite difficult. But there's a few ways you can do it. So if you've got B2B, it's easier because you've got, you know, people that you've pitched to and you haven't heard back from. In B2C, if you have email capture before purchase, then that can do quite well. So either you have, you know, you sign up for an account and then you have the purchase, you have a sort of pop-up that captures email. That will be a good way of doing it. But it's not easy, and like that's why that insight is so valuable, because it's actually not easy to do it. But you still should be looking for that audience, because those are the guys who you really want. So for Monica Vinader in that case, it's like the people who are like, I like this, it's a little bit too expensive. That's the most valuable thing, rather than talking to some random people on the street who may or may not be interested in your product. We're conscious of our time, but I'm happy to stay a bit longer if people have some more questions. Yeah, and if you've got anything else, feel free to ping it a note. But yeah, I think we'll probably call it a day. But yeah, thanks guys. Hope that was useful, and I will speak to you guys soon.